Hey everyone, welcome back to Corporate Decoder, the place where we will, let's just say we uncover what the big boys are trying to hide in plain sight in their latest SE filings. Today we are diving deep into a registration statement from Total Return Securities Fund. This is not just any filing, it's a look at their plans to issue new shares, a move that always gets our financial antennas up. We want to see if this offering is a genuine opportunity for growth or just a clever way to boost assets. We will be dissecting the financials, the risks, and of course, the juicy details that most people skim over. And if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down more of these filings. This document is titled Form N-2, and it essentially serves as a registration statement for securities offered by investment companies. Think of it as the official announcement to the world that Total Return Securities Fund is looking to sell more of itself. They are doing this through a rights offering. This means existing shareholders get the first crack at buying new shares. So what is this all about? Essentially, the fund is giving existing shareholders what are called rights. These rights allow shareholders the option to buy new shares of the fund at a specific price. It sounds simple enough, but with these kinds of offerings, there are always layers to peel back. Here is where it gets interesting. On the 2nd of October 2025, the fund's value per share, its net asset value or NAV, was $7.1. But the market price, what people were actually paying for it on the New York Stock Exchange, was $6.08. That's a significant discount, over 14%. This hints that the market sees the fund as less valuable than its underlying assets suggest. Many investors are already buying in below NAV. Now the catch, the price at which shareholders can buy these new shares. The subscription price will be 85% of the NAV on the day the offering expires. This means current shareholders can buy in at a discount to the fund, S-owned valuation, which might sound good, but we need to see the entire picture. Scroll the offering will dilute the NAV of shares owned by shareholders who do not fully exercise their rights, and such dilution may be substantial. Scroll this offering carries a significant risk of dilution. If you do not exercise all of your rights, your share of the fund's value, its NAV, will decrease. The report even warns this dilution may be substantial. This means if you don't participate, your existing investment could be worth less in proportion to the fund's total assets. Scroll the offering will dilute the voting power of shareholders who do not fully exercise their rights, since they will own a smaller proportionate interest in the fund upon completion of the offering. Scroll it also dilutes your voting power. If you own 100 shares and the fund doubles in size through this offering, and you only buy 10 more shares, your voting power goes from representing 1% of the fund to effectively 0.5%. Scroll the offering may cause the discount below NAV at which the fund's shares have recently traded to increase, especially if rights holders exercising the rights attempt to sell sizable numbers of shares shortly after such issuance. However, this possibility may be mitigated by the fund's commitment to conduct the self. Tender offer described in summary the offering below. Scroll and here is another big warning. This offering could make the existing discount to NAV even worse. If a lot of people exercise their rights and then immediately try to sell their new shares, it could flood the market and push prices down further away from the NAV. They do mention a planned self. Tender offer to counteract this, but we will have to see if that truly mitigates the risk. This is a big one. You exercise your rights and pay money without knowing the exact price you are paying. The subscription price is set 85% of the NAV on the expiration date. You commit your money before that price is finalized, and once you do, there is no going back. This is a serious lack of transparency and a risky proposition for any investor. Scroll for the years ended the 31st of December. 2024 net asset value at the beginning of period year $9.76 total from investment activities, 0.29% net asset value at end of period year $8.94. Scroll. Let's look at the financials. For the year ending the 31st of December 2024, the fund started with a net asset value of $9.76 per share, but through investment activities, it actually lost value, ending the year at $8.94. That's a negative return, which is never ideal for an investment fund. Scroll for the years ended the 31st of December 2024 total investment returns based on market value per share minus 2.49% fry and scroll. If we look at the market value per share, it fared even worse. It saw a negative return of nearly 2.5% for 2024. This suggests that not only is the fund underlying assets not growing as hoped, but the market is valuing it even less than its NAV. Scroll shareholder transaction expenses, offering expenses, 0.17%, scroll even with all these risks and less than stellar performance. There are still expenses associated with this offering. They estimate offering expenses to be about 0.17% of net assets. While this might seem small, remember it is an expense on top of everything else that could eat into returns. Scroll total annual expenses management fees, 3. 1.00% other expenses, 4. 0.61% total annual expenses, 1.61% free scroll. Looking at the annual expenses, the management fees are a solid 1%. Add to that other expenses, and your total annual expense ratio is about 1.61% in the investment world. This is not outrageously high, but for a fund that has been struggling with performance, every fraction of a percent counts when it comes to your returns. Scroll risk factors decline in trading price. If the fund's trading price declines below the subscription price, you will suffer an immediate unrealized loss. Fady scroll now for the risks, and there are many. The document lists a whole section dedicated to them. A major one is the risk of the trading price declining below the subscription price. This means you could buy shares at the subscription price and immediately see their market value drop below what you paid, resulting in an instant unrealized loss. Scroll risk factors discount to net asset value NAV. The fund's shares of common stock have historically traded on the NYSE at a discount to the fund's NAV per S-hair scroll. We've already touched on this, but it bears repeating. The shares have a history of trading at a discount to their net asset value. This is common for closed-end funds, but it is a persistent risk. It means the market price can be significantly lower than what the fund's assets are actually worth. Scroll risk factors dilution of ownership. As a result of the terms of this offering, shareholders who do not fully exercise their rights will own upon completion of this offering a smaller proportional interest in the fund than they owned prior to the offering. Scroll, and of course we have dilution. If you do not participate in this rights offering, your ownership stake in the fund will be smaller. This means your say in how the fund is run and your share of its future profits will be less than it was before. The fund states its investment objective is to provide long-term total return. This is a pretty standard goal, but achieving it is another story. It is also important to note that this is a closed-end management investment company. Unlike mutual funds that can issue and redeem shares daily, closed-end funds have a fixed number of shares. This can make them less flexible and more prone to trading at discounts or premiums to their net asset value. Scroll investment restrictions 1. Invest 25% or more of the total value of its assets in any particular industry, except that the fund's investment in closed-end funds, including business development companies, shall not be deemed to be an investment in a particular industry. Scroll digging into the investment restrictions. A key one is that they cannot put 25% or more of their assets into just one industry. However, they add a curious exception. Investing in other closed-end funds, like business development companies, does not count towards this industry concentration limit. This could allow them to concentrate heavily in specific opaque areas disguised as industry diversification. Scroll investment restrictions. 5. Make short sales of securities or maintain a short position in any securities, except that the fund may make short sales of securities or maintain a short position in securities for hedging and risk management purposes. So troll, they also have a restriction on short selling, essentially gambling that a stock price will go down. They can do it, but primarily for hedging and managing risk. This tells us they might be willing to take some directional bets, but not in a way that seems overly speculative. Looking at the capital structure, the fund has provisions in its charter that could make it hard for an outsider to take control. This is fairly common to protect existing management and shareholders from hostile takeovers, but it can also shield them from shareholder activism that might be beneficial. Scroll management ownership to the knowledge of the fund's management. As of 2025, the directors and officers of the fund beneficially owned, as a group, less than 5% of the shares of the fund's common stock. Scroll now for management ownership. As of a date in 2025, the directors and officers collectively owned less than 5% of the fund. S-stock. This is quite low. Warren Buffett famously advocated for significant insider ownership because it aligns management S interests with shareholders. A low ownership percentage here might suggest less personal stake in the fund's long-term success, at least financially speaking. So what is my take on this filing? Total Return Securities Fund is navigating a tricky path with this rights offering. On one hand, they are trying to bring in more capital to potentially capitalize on opportunities, all while offering existing shareholders a discount. However, the fund has shown a history of underperformance, trading at a discount to its own net asset value, and this offering carries a significant dilution risk for those who don't fully participate. Essentially, they are asking investors to put more money into a fund that has not been growing its value recently and whose shares are already trading below their stated worth. The lack of price certainty at the time of subscription is also a major red flag. While the market discount and the 85% subscription price might seem like a bargain, the underlying performance and the inherent risks of dilution and potential further discount widening make this a high risk proposition. It feels like a business trying to grow its asset base, but the underlying performance suggests that growth may be harder to come by than they are letting on. Alright, that is our breakdown of Total Return Securities Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.